Good morning, everyone, and welcome to the Daily Trader with Kevin Hinks. Today, we're going to look at some macro data, and we're going to look at two practice trades. One in Apple coming out with earnings tomorrow after the bell, and Amazon coming out with earnings after the bell. So two members of the Magnificent Seven, two key players in this earnings season coming out with earnings tomorrow after the bell. We'll cover both of those. But first, let's look at today's economic data, GDP. A really interesting level of GDP. So third quarter GDP comes in at 2.8%. This is the first reading for third quarter GDP. That's a little less than the 3% expected. But how about this? Personal consumption expenditures, the annual rate comes in at 3.7%. That is telling me that the U.S. consumer is still a major player, and an employed U.S. consumer is still willing to spend money. Now, there were some alarming factors in the GDP data, and it's personal income, $221.3 billion, down from last quarter at $315 billion. Disposable personal income, $166 billion, down from last quarter at $260 billion. Personal savings rate, $1.04 trillion, down from the second quarter, $1.13 trillion. And personal savings rate, 4.8%, down from 5.2%. So strong U.S. economy, but personal income lower, disposable personal income lower, savings and savings rates all lower. So some concerning numbers on the horizon there. But right now, personal consumption, strong number at 3.7%. All right. Now, looking at today, you've got the dollar lower. You've got yields lower. Yields is an interesting story. Yesterday, we had a 7-year note auction, and yields were higher and had been moving higher throughout last week and into yesterday. The strength of the demand for bonds turned the bond market and the yield market. And now you see yields all the way down from 4.3% down to 4.22%. So pretty interesting turn of events there, and all because of the demand in the note auction. All right, let's get to our trades. First one, Apple. Apple's going to be a key news driver for the next 24 hours and into tomorrow. And why? Well, because expectations and valuations are the two key drivers. Apple has already rallied, as you know, on the hope that the iPhone 16 is going to promote this super cycle or create this super cycle for new demand for the 15 and 16 because of the AI features, Apple Intelligence. Does that happen? Well, that's what we have to find out. Qorvo, one of the Apple suppliers, is down today on sales. Remember, that's a key Apple supplier. That's a little warning sign. But so Apple has so many great things going on, but the most important thing Apple has is their ecosystem, their brand loyalty. Once you are in the Apple world, it's very difficult, or you don't want to get out of it. That could be your Mac, that can be your laptop, that can be your earbuds and iPads and the phone. There's so many different things that can bring you into the Apple world, and they're all connected, as you know. That said, the expectations are iPhone. That doesn't mean it won't be, but maybe it isn't yet in terms of the super cycle. Maybe we're not there yet. Maybe going into the holiday season is when it'll happen. We'll see if it happens yet. I still think there's some uncertainty there. And the bigger problem, the valuation on Apple. North of a 35 PE is a problematic level for Apple's price-earnings ratio to be. So there is something you have to be concerned with. So Apple could come out with good numbers, and you know they're going to repurchase stock, and they get at the end of second quarter, they had $62 billion in cash sitting on their books. So they've got a good story. That doesn't mean the stock's going up when they release earnings tomorrow after the bell. So it's a complex trade. So it's something that we look at where you sell a call vertical. In this case, I sold this week's 240, 245 call vertical. Now, if you look at Apple's page, it's got an expected move of about $7.26, and that can move all the way around. I lined it exactly up with the price where it's trading now and the expected move to sell the 240 call, buy the 245 call, then use that credit to purchase the 225, the 1 week, the November 8th, November 1st put calendar, right? And that's the 225 strike. So selling a call vertical above the market and buying the 225 1 week put calendar. And you do that whole package for around a 25-cent debit, right? You're using some of the credit to purchase the call the put calendar. Now, why do you do something like this? Well, what if nothing happens, right? What if Apple comes out and the stock stays relatively unchanged? Well, this trade is profitable in that, because if you look at the profit graph right where it's at right now, you're collecting theta. You're short about 17 deltas, but that call vertical, if nothing happens, will go to zero pretty quickly, and what you'll have left is the put calendar. So spending just 25 cents is trading a little north of 30 cents now. The stock has moved a little lower since we put this trade in, but this is a trade that takes advantage of this. It is a put calendar being financed or made less expensive by a call vertical. All right, so there's our trade for Apple for earnings coming out tomorrow after the bell. Let's get our second trade, and that is Amazon. Now, Amazon is an interesting story because last quarter, if you remember, they hit Amazon stock really hard on their earnings event. The stock sold off incredibly, a pretty big percentage. Why? CapEx spending. Microsoft goes through these cycles. You can see right there on the chart that big drop after the last earnings event. But stock has rallied most of the way back to where it was, but that was a pretty volatile day for Amazon stock because CapEx was a big number. And this is what Amazon does. This is the kind of the personality of their company. They go through these cycles where they spend a lot of money and then they stop spending money and let the profits from AWS, the margins from AWS, the profits from and the revenue that they bring in from e-commerce all show up on the bottom line. They continually make the company more efficient. But when they're spending, the stock they don't really like it. And when they're not spending or spending less or becoming more efficient, the stock usually rallies. So it's going to be an interesting earnings play in Amazon. But think about this. AWS, Google Alphabet came out with earnings this morning. Incredible power of the cloud. And AWS, the leader in the cloud. It's AWS, it's Microsoft Azure, and it's Google Cloud are the three main players in cloud. And in my opinion, the cloud is just getting bigger and bigger and bigger. The compound annual growth rate for the cloud's supposed to be 15.5% through 2030. That means there's amazing opportunities there, and Amazon is the leader in cloud with AWS. So that and the fact that maybe they will watch the CapEx spending, that's key. Can all the massive amounts of revenue they take in from e-commerce, can that show up on the bottom line? And think about this. The change in people's activities. Look at the stock of Walgreens Boots Alliance. Look at the stock at CVS. People don't go to those stores anymore to buy things. You point and click on Amazon and you buy them instead of brick and mortar that has to lock up the toothpaste. You can just get it on Amazon, and it's getting more and more popular. Not to mention Prime Video, and they're getting into football and live TV and all the things that they're doing there. This is an amazing company, but it's all about the CapEx spending. Doesn't mean it can't sell off. Look at last quarter. Sell off pretty hard. So the trade we're doing for Amazon is a bullish play. The risk here is the debit paid. I went out to next week, bought the 192.5 call, kind of an at-the-money strike here, about $1 in the money for Amazon. Bought the 192 call next week, sold this week's 202.5 call. Yeah, I'm getting very granular with my strikes because options allow you to do that. It's about an $11 move. And could you do the 205? Yes, you could. And depending on when you put this on or where the stock is trading, you could do the 205 and line that up with the expected move. Where do I get that expected move? The market maker move right there on the top of the Thinkorswim platform and in that right column on your Thinkorswim platform. So let's get back to the trade. The November 8th, 192.5 call, selling the November 1st, 202.5 call. It's a call diagonal. It's trading about $5.15. It's trading a little higher now. Amazon has rallied. Apple has sold off. So this trade is trading, look at now, about $5.30. But this is a call diagonal in Amazon, looking for an upside move through that $200 strike and up towards 202. Now, the previous one-year high is about $201. So this has got to be an earnings release by Amazon tomorrow after the bell. That is going to be, it needs to be impressive. For this to work, it'll have to be impressive. This is a bullish posture. Apple, the trade, a bearish to neutral posture. This in Amazon, a bullish posture. So we did a complex trade in Apple today with a short call vertical financing a long put calendar. In Amazon, we did a call diagonal. Remember, the risk on the Apple trade is the width of the strikes in the call vertical. That's your risk there if it were to move to the too far to the upside. And the risk in the diagonal in Amazon is what is the debit that paid for it. All right, that's today's Daily Trader. Good luck out there, everyone. It's earnings season. It's a very busy time of the year. Have a great day. See you tomorrow.